Welcome back. Earlier today, it was reported U.S. construction spending rose in April 1.2%. That was after rising 0.3% in the prior report in March. Residential construction rose 0.5, non-residential gained 2.4. We're going to take a look at a couple charts that really show the disparity within the construction sector. It's one of the more interesting reports we've seen as of lately. Public construction's up 1.1, education fell 0.1, highway up 1.3. So the big number is non-residential construction skyrockets 2.4%. This is total construction in blue. The red line is the S&P 500. We can see going back to 2015, a steady rise to the upside. Obviously, we've seen some hiccups along the way, but considering what we've been through economically, construction has actually been very steady, even taking into consideration the downturn we saw in early 2020. There was a blip in construction, but it came right back. Notice the divergence. Stocks hit highs back in 2022, January, around that area. Construction continues to rise. Also keep in mind, construction continues to rise in light of interest rate hikes. It doesn't seem to bother this industry, but then again, it actually does, just in a certain way. The blue background chart is the S&P 500. Now, the green line is non-residential construction. That was up 2.4% in this report. The red line is residential construction. Now we can see where interest rates are hurting construction in the residential side, and that is the takeaway. For whatever reason, we can really dissect this, why higher interest rates don't seem to hurt non-residential construction as much as residential. If anybody has any particular opinion, we'd love to hear why. But there certainly is a divergence. Now, here's residential construction in blue, S&P 500. Actually, a pretty strong correlation. Stocks go up, residential goes up, stocks go down, residential construction goes down. It makes sense. You know, the stock market is more closely correlated to residential construction because we think of not only the home builders, but also all those other companies, like Home Depot and, all these other companies that would benefit from the construction industry. Everything from, appliance makers and, all those different things that go into a home. Here's non-residential construction. Notice the divergence. We had a little bit of a downturn back in 2021. Now notice it has more recently just skyrocketed higher. For some reason, whoever's involved in non-residential construction, they see something maybe the rest of us don't see. Here's commercial construction in blue versus the S&P 500. Also a very similar pattern, just skyrocketing higher. Highway construction, also very strong. Healthcare, very strong. Manufacturing, very, very strong. Manufacturing construction. Office construction sector, not making new highs like the other sectors, but certainly a lot stronger than the residential. Now, here's something really interesting. Lodging. Lodging construction really took a hit, and was really hurt coming out of our stock market debacle in 2020. And we see even after the fact, there's a hangover effect where the market, the industry just could not, get back on its feet. Lately, it's moved up, and we'll see in a moment there's been some really big percentage gains, but off the bottom. Really, this is the laggard. Lodging, hotel construction, things of that nature. I guess this industry just does not see a tremendous amount of growth. Now, we talk about all these different sectors because we hope maybe it'll be helpful if you're trying to rebalance your portfolio or look for investments in the stock market. Look at those companies that are involved in non-residential construction as opposed to, and manufacturing construction as opposed to lodging construction. Well, that's actually been up lately, but certainly has really fallen behind. Power construction doesn't look so hot either. Here's a transportation construction sector versus the S&P 500. It's strong, but it's not the strongest. Here are all the construction components put together. Now, The shining star in this, well, there's a few of them. The red line here, that's manufacturing construction. Take a look at this. We moved, nearly 50% in the past couple years to the upside. This blue line represents commercial construction. The green line below is lodging. Now, we've seen a big bump off the bottom, but that is just what it is, a big bump off the bottom. It is a laggard. Now, in terms of applying this information to the stock market, we may say, well, I'll invest in lodging construction companies because maybe they'll catch up with the rest of the sectors. But the fact of the matter is, it's weak for a reason. And if the economy takes a move to the downturn, this is already a weak sector. I would not feel comfortable, putting any kind of investment into the worst sector or the lowest sector within the construction industry. If we expect the construction industry to continue to be strong, it looks like manufacturing, commercial construction, those certainly have been the winners. Highway and street construction, this orange line is also right up there as well. Now here's the monthly changes, 8.6% to the upside in manufacturing construction. That is really the shining star in all of our sectors over here. Here's the yearly change, 104%. If we were in the manufacturing construction industry a year ago, that's up over 100% in terms of the spending. Here are correlations which are quite interesting. There's some pretty obvious, connections between different components. We have non-residential construction that has a 94% correlation with a highway, 89% healthcare. Manufacturing is also very strong. That's non-residential. The residential construction industry doesn't really have a very strong correlation. I see it's strong to commercial, but maybe not. That's not such an obvious, takeaway. What I find to be very interesting, and this is again kind of an obvious connection, but highway construction has a 93% correlation to transportation construction. So when money is spent to build and repair highways, well, that also we see that effect take place in the transportation sector as well. This is the yearly performance overall. On the left-hand side, we see total construction going back to 2003. Now notice, let's go to 2019. 2019, the power construction industry was up 44%. 2020, we saw a lot of bad news, down 30% in lodging, down 32% in 2021. Now, it's back up 40%, but then again, we take as an investment, we lose 30% 1 year, we lose another 32% the next year. Finally, 2022, it's up 40%. Well, not such a big deal. We're still down a lot. Compare that to manufacturing construction. 2020, it was a bad year. This was only down 6%. Meanwhile, up 24% 21, 54% 22, and it's the leader this year so far, 2023 year to date, up 36%. So it really does go to show you, for a trend following strategy over the long term, it makes sense. What works tends to continue to work. Now we can look at fundamental analysis and interest rates and, what makes these sectors work. I think certainly that's valuable information. But just on the surface, take a look to see what's working. What's working has a good chance, I think, to continue to work. Take a look at residential construction. Now that bounced. Obviously, we had lockdowns and, there wasn't a lot of construction. That came back 23% in 2020, 21% in 2021. Now 4% down, 22, 0 for the year so far. Residential construction just ran out of gas. It seems that all the money that was being spent in residential went over to manufacturing, non-residential, and these other better, stronger sectors, I should say. So it really is kind of interesting how money tends to change hands over time. Now, we wanted to get back to the bond market because we saw a really interesting development the other day. Today's change in U.S. Treasuries by yield kind of flat on the short term, up 0.2. That's 2 basis points. The biggest moves, 1-2-year bonds are down 7 basis points. Not a huge move for treasuries, but important to note the trend. This is where current U.S. treasuries sit. Now, of course, if you've been following us for any amount of time, you notice that the 1-month T-bill was at 6% the other day. It has fallen precipitously, down 70 basis points in one day. That was just the other day. We're at 5.3%. We have 2-month bonds at 5.39, 6-month at a 5.44. Notice that 1 year now is really kind of falling. 5.11. The 10-year at a 3.61. We see historic spreads between the 1 and 10-year bonds, which we're going to take a look at just in a second. Here's the 1-month change in bonds. The 2-year, this is where the capital is going. The 2-year is up 15%. Now, this is 15% in yields, which means when yield goes up, the price of the bonds actually goes down. It means traders are actually selling the 2-year bond. They're buying the very short term, the 1-month T-bill. Why are they doing this? Well, one takeaway or one opinion is that traders see, or the market overall sees, trouble on the horizon, and they're saying, well, I want to get out of stocks and I want to keep my money in, short-term securities. I don't want to invest in a long-term security and get locked down for, a long-term commitment. Let me park it in some short-term paper. And the shortest term paper, as they say, is the 1-month T-bills. That drop in yield represents a lot of money moving into the T-bills, into the 1-month T-bills. It's moving out of the higher yields. Notice how the majority of the selling is really taking place right in the middle, in the fat part of the yield curve. Very interesting. I think the market has just sold the short-term bonds to such an extent, the longer-term bonds to such an extent that it's now looking to sell the short-term ones, or the moderate, medium-term ones. This is the 1-month change in yields to give you a graphical point of view. The blue histogram bars in the background, that's the S&P 500. We're just flirting with almost new highs nearly every single day. Now the dark black line over here is the 1-month T-bill, and if we were to go back, we would see it was actually quite low a while ago, but then was hovering right around 6%, around 6.02 on May 26, just a few days ago. Dropped 70 basis points. The highest yield you get now is at the 4-month bond. Notice on the longer term treasuries, we see at the bottom, the 10 years, a dotted red line. That's the lowest yield. That's where the money is moving into. And what this tells us also, the prices act as, not only as a reflection of where the market's going, but it also sends us a signal in terms of the market opinion. And the market opinion, the fact that the 10-year yields are so low, sub 3.5% or right around that area, it shows us the market over the long term does not have a lot of faith in the economy. Now, then we would say, well, why is a 1 month falling down? And we have a chart in just a second, and I think really explains this phenomenon. It's very interesting. Here's the current market. The histogram bars in the background show the S&P 500 just flirting with new highs all the time. 1-month T-bill in black, falling 70 basis points. Now, the 1 year's red, the 10 years purple over here, and we can see the purple is really kind of falling out of bed. It's moving away from the 1 year. The spread is widening between the two. All these yields seem to be falling. Now, there's two big moves. One is the long term, the 10-year, falling a lot. The other is the T-bill, the very short term, also falling a lot. What I believe we could be seeing could be, and this is just an opinion, the market changes every day, but we saw a similar phenomenon occur early 2007. Black line is a 1-month T-bill. Notice how strong it was. It was the highest yield, around 5.18. We're going back to March 16th of 2007. The 1 year is red. The 10-year is purple. Notice the 1 is above the 10. We have an inverted bond market, just like we do now. The red is above the purple. In 2007, the red's above the purple. Right now, we had a very strong, it's still relatively speaking, it's still a very strong T-bill, black line. It's still very strong. It's above the rest of them. T-bill is also very strong at this point. But notice what happened. And the histogram bars in the background, that's the S&P 500. So we're chugging away. We're making new highs. We made actually even slightly new highs going back to October 9th, 07. So if we just looked at the stock market, say, hey, S&P 500 at 1565, things are looking good. But those of us, that know better, we watch the bond market. It gives us another angle to the economy. Notice what happened to the black line, the T-bill dropped precipitously. That was a huge move. That's why I'm really on the lookout for fast, sharp moves down in the 1 month T-bill. I don't know that this is going to mean what it meant in 2007, but I think it's worthwhile to, keep an eye out for it. The 1 month T-bill, July 31st, 07 was 513. By August 20th, less than a month, 247, 300 basis points, right around there. It bounced back up. That was one big day. We can research what exactly happened August 20th, 07. I think, what was it? I know there was something on the political landscape. I can't recall. If anybody remembers, please, leave a comment. I remember August 20th, there was something big of 07, and I think that's why the T-bill dropped. Anyway, it recovered, but then that was, as they say, that was it. The 1 month T-bill leads the market lower. What chased the black line, the T-bill down? The red line, the 1 year. The inverted bond market ended, the T-bill goes down, the 1 year goes down, and then the purple line follows. And then, of course, we know what happened with the stock market during that period of time. So, again, what we're looking for is first a precipitous, a fast drop in a 1 month T-bill. Then we're looking for the 1 year, the red line to follow, and for the inverted bond market to end. That's stage 2. Right now, we still have an inverted bond market. Is this drop the beginning? This T-bill drop, is that the beginning of what we saw mid-07? Well, only time will tell, but we're going to keep an eye out for it. And then, of course, take a look at the inverted bond market, which is almost every day making new lows. The histogram bars pointing down show us the inversion to the degree that the 1 year, the red line, is above the blue line. It's a 154 spread. That was just the other day. That's May 31st. The 1 year bond was 154 basis points, 1.54% more than the 10 year. That is a huge disparity. 3 times what we saw in 07. 07 was only 50 basis points. Here it's 150. What that means, I don't know, but it's a lot. But again, remember, if the 1 month T-bill drops, the next thing we're expecting is a red line across below the blue. So we're going to keep a very careful eye out, on the economic calendar and, of course, the market reaction. And we have more economic calendar events to talk about in the near-term future. We hope this has been helpful. We look forward to seeing you back soon.